Do you want to learn how to actually read and understand any company's income statement in 1 minute or less? Then you've come to the right place. Welcome to the CSuite Network. I'll show you how it's done. On screen, I have 6 years worth of income statements for our example company, Apple, okay? Every income statement is structurally going to look the same. Now, one of the most important ratios we want to calculate right away is the net income percentage. Just take the net income and divide it by the net revenue. What we are looking for is a 20% plus, around a 20% plus net income ratio for at least 5 years. Again, at least for a period trending of 5 years, okay? Now, a higher net income ratio may seem obvious to you, but what is it not telling us? Why is a high net income percentage so important? Okay, a high net income percentage of 20% or more indicates the company has some type of competitive advantage. It may also most likely indicate the company has good cash flow and competent management that is preparing for its future. Okay, again, if you see a company with net income percentage of around 20% or greater trending for at least 5 years, it indicates a company that has some type of competitive advantage, is doing something right, and is worthy of a consideration for an investment. If you want to know more, I go into more depth here. This video is just a primer for you. Now on the reverse, we want to avoid companies that have a net income percentage of 10% or less. Okay, net income percentages that low indicate highly competitive industries and the fact that the company probably doesn't have a solid and sustainable competitive advantage, okay? Nothing special to it. There's no hidden gem. It really indicates that the company is just any other old company providing any generic product or service. Okay, now there's nothing wrong with highly competitive industries. It's just that a company with net income percentage of 10% or less has a smaller margin of error for product quality, product innovation, and execution than a company with wider net income margins. Okay, one misstep from the company along the operational supply chain could spell disaster for the company because it's walking on such thin ice. Low margins also indicate a stressful corporate culture where most times things have to be done a particular way, right? There's not much freedom, there's not much innovation, and that makes sense because it's such a high stakes operation. In industries with low margins, in industries with tight competitions, companies rarely stick their necks out, okay, out of pure survival. They can't afford to take that many risks. Okay, now I'm not saying these are bad companies. I'm just saying from an investment perspective, it's going to take you a lot longer to get your money back when you're investing in a company with low net income percentage margins because it doesn't have enough cash to invest back into its business. Now, if you haven't realized it yet, ratios really do paint an incredible picture of what exactly is going on in a company and whether it's going to be a good investment for you. Okay, a company with net income percentages of 20% or more for at least 5+ years is generally a candidate worthy of consideration for investment because it probably has a competitive advantage, it has more money to innovate, it can do R&D, it also can tinker with its product line, okay? More money gives you more options. That's why we want to see those high net income margin percentages. Okay, a few more important things to note, but quickly as an introduction, my name is Nelson Alvarez. I'm a CPA and executive management consultant. All right, let's keep this discussion going. All right, next ratio to calculate is the gross profit percentage. That's simply your gross profit divided by your net revenue. The GP margin indicates how profitable your standalone product or service actually is. Now, on its own, this number doesn't mean much. You need to compare this number to similar companies in your industry because there is no one good or great GP percentage. It's all relative to your competition. Obviously, a higher GP percentage margin is better, okay? But you cannot look at it in isolation. Again, investors need to know whether you're even charging enough for your products or if you're paying too much for your supplies, right? Okay, this is why you have to see what your competitors are doing to see where you stack up. Again, knowing your target company's GP percentage as it compares to direct competitors is a quick sanity check to say, yes, my company is an industry leader, or no, it's not. Okay, last, let's look at one more ratio that is super important in determining if a company is worthy of investment. It's the interest expense to operating income ratio. If your interest expense to operating income ratio is 30% or greater for at least a period of 5 years, it indicates that the company is a highly levered company that is reliant on bank debt to fuel its growth and run its day-to-day operations. Now, why is that bad? It indicates that the company essentially cannot stand on its own. It cannot produce enough profit or cash from its own product or services to essentially live on its own in the wild. It's on life support from the bank. This is not a great investment, as Warren would say. We want companies that are self-financing, that are not reliant on other banks or institutions in order to keep it alive. Okay, if a large chunk of my profit is going back towards paying off loans and paying interest, that is less money I can put back into my business or even issue dividends to shareholders. If we look at Apple's interest expense to operating income, we can see it's only about 4%. That doesn't even include the fact that Apple's interest income actually exceeds its interest expense. So on a net basis, actually pays nothing in way of interest expense. Okay, in recap, high interest expense to operating income, anything over 30% for at least a period of 5 years is cause for concern. Okay, these are some major points that you can look at an income statement in 1 minute or less to quickly determine whether it's a company worthy of consideration for a future investment, all right? If you want to learn more, you can check out the link above. They go into much more detail into income statement analysis. Hope to see you there.